Hi, this is Tim Phillips, CEO at Phillips and Company Advisors, and I'd like to thank you for taking a look at our Q4 2023 look ahead. Please read all the disclosures carefully. After a prolonged period of rate increases, the consumer is finally getting shaky. Consumer confidence is eroding, wage growth is moderating, and credit delinquencies are on the rise in almost all aspects of consumer credit. Add to that, student loan payments are about to recommence, which could be as much as a 12% drag on monthly spending. The Fed will continue to hammer the consumer with restrictive monetary policy. The Fed set expectations for interest rates to rise one more time this year, and then by the end of next year, we should experience a series of rate cuts at a very slow pace. Again, that's what the Fed's expectations are. The historical reality is rate cuts come fast and furious. You can see that in the chart on the lower left. The forecast is for this smooth series of cuts over a long period of time, but history suggests a steep cliff of rate cuts. It's our view the landing spot for the Fed funds rate will be around that 4% range versus the below 1% range we've seen since 2010. Lots of that will be supported by higher wages and better American productivity. Now, the terminal rate might even be higher than 4% if the Fed continues to trim their balance sheet and sells more treasuries off of their books. The Fed's economic hit job is just starting to work its way into everyday life. Mortgage rates are at highs not seen in decades, and banks are losing deposits at a rapid pace due to higher rates on treasuries. Banks simply can't keep paying to hold deposits, and that's why lending officers are forecasting even tighter lending standards ahead. All of this will create a drag on employment and continue to soften the economy. I know it sounds like I'm painting a pretty dour picture on the macro level, and it's true high rates will tamp down the U.S. consumer and economy. However, that's not happening on a headline basis so far. GDP growth should top 4% in Q3. Corporate earnings should finally turn positive after 2 quarters of declines. Again, much of this is driven by the base effect or year-over-year effect. We're coming off a very strong 2022 for corporate earnings, making 2023 hard by comparison. Now, carrying that notion forward, 2024 should be a strong year for corporate earnings growth. Again, driven by the base effect, and as long as the U.S. consumer doesn't weaken up too much. Perhaps that's why we need the Fed to follow their historical pattern of sudden cuts versus their expectation of gradual cuts over a number of years. While valuations are rich, earnings growth can help moderate those valuations. As a side note, and you can see in the lower right, and a little bit of a tutorial, earnings growth and dividends make up 96% of all returns. That should suggest we have a solid 2024 in S&P 500 returns. While developed markets are trading at significant valuation discounts to the U.S., their full year 2024 corporate earnings growth looks to be muted. Again, some of this is from that base effect we talked about earlier, after they had pretty strong first half 2023 earnings growth. We continue to underweight developed markets as their economies produce anemic growth for GDP in that 1% range. This looks like another year of negative returns for fixed income, and 3 years in a row is unprecedented. With China selling off treasuries, we should continue to see some oddities in the very inverted yield curve. The real question for us is, when should we shift from very short duration to moderate duration? It would appear a shift at the last Fed rate hike might be the right time. We're looking to move our way back to benchmark duration as the slide would suggest in the lower right. Emerging markets are in a unique situation as the strong U.S. economy and dollar have hobbled their growth in some regards. Mostly the strong dollar has shifted investments out of emerging markets and back to the United States. However, when rate cuts ensue, emerging markets perform handsomely. A modest drop in the dollar has led to over a 50% rally in emerging markets in the past. Now, combine that with a great recovery in earnings growth in 2024, and we should see some strong results, especially when emerging market valuations are 36% below the United States. I know we started this presentation off with a lot of negative news. As we worked our way through corporate earnings growth reemerging in 2024, I wanted to show you a lot of historical patterns. The historical patterns suggest that we're getting close to better times ahead. Seasonally, the S&P 500 looks poised to rally. Pauses in FOMC tightening cycles lead to rallies. Large drops in inflation leads to rallies. And just the seasonality where we're at in the lower right can lead to nice performance over the last 10 years. So the bad news probably leads to some pretty good news as long as we get the Fed to behave accordingly. So here's our views and recommendations. We certainly expect the Fed to raise rates one more time in this cycle and then pause, perhaps cut rates this time next year and at a little more rapid pace than they are suggesting with their forecast. While the U.S. consumer is showing early signs of distress, it's not completely certain they'll collapse totally. Both developed and emerging markets will benefit from a pause in the interest rate cycle. However, we believe emerging markets will benefit more with a weakening dollar. Our recommendations are for you to continue to reaffirm your investment strategy, maintain strategic liquidity to cover spending needs, as well as provide opportunities for dollar cost averaging. We think you should rebalance back to target weightings to take advantage of recent pullbacks in U.S. equities, emerging markets, and especially U.S. small cap. We continue to overweight emerging markets, and we're going to start migrating back to benchmark fixed income duration as the Fed nears their estimated peak rate cycle. You can see our mean reversion dashboard here. And again, it makes the point that small cap growth looks to be the most favored U.S. cap to invest in. Looking across regions and countries, China's very much undervalued, as well as Brazil. And then again, if you're looking at sectors within the U.S., energy and real estate, which have fixed payouts, have performed poorly, but should perform well as U.S. rates begin to get cut. Thank you for taking the time to review our Q4 2023 look ahead. And if you have any questions, comments, or concerns, please reach out to your advisor, or you can reach me directly at my email below.